Good day everyone. Today we'll be using the new era accounting grade 12 textbook. It's an old one. Accounting textbook. It's a learner's book. Task 7.13. It's in page 341. We'll be doing a fixed tangible asset note. We'll also be doing a T account, asset disposal, and a general ledger. So let's get to it. There's the given information. We'll have to first go into the land. We'll start with the fixed asset note. So there it goes. We have the information there. We have to fill in the stars. Where there's the stars, we have to fill in. So we all know that the fixed asset note is prepared so that the business can know their assets value. What is the value of the assets at the end of each year? So let's start with our timeline. I always advise that you always have a timeline. So the year ends in this activity. The year ends on the 28th February 2008. Yeah. So you write there 28 Feb 2008. And then if the year ends on the 28th February 2008, it means that it started on 1st March 2007. Yes. So we are starting with the what? Note number 3. That's what they say it is. So there we go. The given amount in the land and building is that 1,200,000 under the cost, and then there's no amount there. And then we also have an amount at cost at the end, which is 1,300,000. And then under the vehicles, we have an amount under the carrying value at the beginning of the year. It is 151,875. And then under the cost, we have 640,000 rands. And then in the equipment, the given amount is the 40,000 under the carrying value at the beginning of the year. And then we also have the accumulated depreciation, which is 160,000 rand. Yeah, and then we also have under the vehicles additions at cost. It shows that we added the business added 240,000. Yes, and then no disposals at carrying value, and then nothing else. Under the equipment, they added 180,000 rands, and then we also given the depreciation, which is 30,000 rands. And at the end of the year, under the cost, we have 180,000 and no accumulated depreciation at the end. So let's start with our land and building. We all know that land and building doesn't depreciate, it appreciates. So we'll never have amounts under the accumulated depreciation under land and building. Accumulated depreciation at during the year, and then depreciation at the end of the year. There'll never be accounts. It's either they buy or sell their land and building. So you see there at the beginning, the cost was 1,200,000. So at the end, the cost is 1,300,000. So that shows that they they bought some land and building. They both bought some land and building during this year. So we want to find out how much they bought, because at the beginning is as less than at the end, meaning they added some land and building. Yes. So we're going to look for the difference between 1,200,000 minus 1,300,000. So they bought new land and building at the cost of 100,000. So it was cost plus additions at cost, and then it's going to give you it's 100,000. Yes. And then you say cost at the beginning, which is 1,200,000 plus 100,000, and then at the end the land and building was costing 1,300,000. So I told you, you can never have amounts under the accumulated depreciation and depreciation for the year, so it will always be a zero. Yes, let's move on to the other one, which is vehicles. So you have to listen carefully here. Yes, so we were given a carrying value at the beginning of the year, and we were given the cost at the beginning of the year. So we want to know the accumulated depreciation. So what we'll do here, we'll also find what the difference between those two, and then we're going to get the accumulated depreciation. So let's do it. Okay, let's say land and building. I'm writing the first calculation. It was 1,300,000 minus 1,200,000, and then the difference was 100,000. And then we are in vehicles. So we're calculating for vehicles now. So there you go. We have a carrying value at the beginning of the year, and the cost. So we also in here, in this situation, you have to look for what the difference, and then that will give you your accumulated depreciation. So let's go. We're going to say 640. I don't have a calculator, that's why I'm using my old phone. Yes, but I'll try to get a new calculator soon. So it's 640,000 minus 151,875, ne? So the difference is 488,125. Yes, 488,125. To double check if this is correct, you have to say 640,000, ne? Minus that amount that you calculated. It has to give you that 151,875. So it's 640,000 minus 488,125. There it is. It gives us 151,875, which is that. Yeah. Then we move, because there were movements there, and vehicles do what? Depreciate. So we have to calculate the depreciation for vehicles. Yeah, so let's calculate depreciation for the year for vehicles. First, we have to go and look for some information from the textbook. So there it is. It says the new vehicles was purchased on what? On 1st July 2007. So now you'll see the importance of your timeline. So we say March, April, May, June. So let's say March, April, May, June, July. So on 1st July 2007, they bought, there it is, vehicles 240. Additions at cost, yeah? 240,000. This is very important when you want to calculate your depreciation, the months, yeah? So there we are. So it's July, August, June, July, August, September, October, November, December, January, and February. So from here till there, we bought that new that new vehicle on the 1st, and it stayed in the business for how many months? It's July, it's 1, 2, 3, 4, 5, 6, 7, 8 months, ne? It stayed for 8 months. So now we want to calculate the depreciation for the new. Okay, we go back again to our information and read, because we have two different methods to calculate depreciation. We have diminishing balance method. We also have cost method. So we want to know which method are we using for for vehicles. They say vehicles are depreciated at 25% per annum on the diminishing balance. We all know that when you do diminishing balance, it's you always say cost minus accumulated depreciation. So in this case, this new vehicle hasn't depreciated yet because it's still new and it hasn't stayed in the business for a year. And so it has no accumulated depreciation. So we're only going to say let's say depreciation for a year. Yes, there we go. And then we say new because we're calculating for new. So new, how much is it? It's 240,000 minus 0 because we have 0 accumulated depreciation. It will also give us 240. And then you say times 25% because they said by it depreciates 25% per annum. And then you say times how long did this vehicle stay for, these vehicles stay for in this business. It stayed for 8 months. Out of how many months? Out of 10 months. So how much did this vehicle stay in the business? It stayed for 8 months. Out of how many months? Out of 12 months. So yes, and then that's how you do it. So in your calculator, you're going to say 240,000 times 25%, then times 8 divided by 12. So the depreciation on new vehicle for the year, it is 40,000. And then we still have old vehicles, so we have to calculate for new vehicles and then old vehicles. We did not sell any vehicles, so we won't have a depreciation for sold vehicles, ne? So we're going to say old vehicles, those are the old vehicles. And they said they must be calculated at what method? At diminishing balance method. I said the diminishing balance method says cost minus accumulated depreciation, and then you get your carrying value and then you calculate your depreciation from that carrying value. So in this case, there is the cost minus accumulated depreciation, there's the carrying value. We'll take that carrying value and calculate our depreciation from it. These vehicles stayed for how long? 12 months in the business out of 12 months, meaning the whole year. We again go to the calculator. So it is 151 875 times 25% times 12 months divided by 12 months. So in the required here, it said that round off to the nearest rands were applicable. So we have to round off. We got 37,968.75 cents. So we're going to say 37,969 because we rounded it off. But 8 will turn into a 9 because of that 7. Ne? Yes, so the depreciation for the year for vehicles will be this amount plus the vehicles on new vehicle on new, the depreciation for new, ne? And then plus depreciation for old. So 40,000 plus 37,969, it gives you, my phone, plus 40,000, it gives you 77,989 because of that 7. 77,989. That is the depreciation for what? For the year. Yes. And then to get the accumulated, the carrying value at the end of the year, Please make sure that you watch the other video on this chapter, because I wrote down how to get these at this carrying value at the end, cost at the end, and accumulated at the end, and how to do a vice versa, downs up, bottoms up way. So please make sure that you watch it. Okay, there you go. We say carrying value to get carrying value at the end, you say carrying value at the beginning. Carrying value at the beginning, which is 151,875, ne? Plus cost, plus additions at cost, ne? Plus additions at cost. If we had disposals at carrying value, we're going to say minus disposals at carrying value. So at this point, we do not have. So we move. We go to the depreciation. We say minus depreciation for the year. It's 969. And then there we go. We getting 313,906. Carrying value at the end of the year. So cost at the end of the year, to get the cost at the end of the year, you say cost at the beginning with 200, which is 640,000. Sorry, 640,000 plus additions at cost, and that is it. And then minus, if there was disposals, you were going to say minus disposals at carrying value, at cost, not at carrying value. So in this instance, we do not have the disposals. So there you go. We got this amount. So I said to get the cost at the end, you say cost at the beginning plus additions at cost minus disposals at cost, not at carrying value. But when you're calculating carrying value at the end of the year, you say carrying value plus additions at cost minus disposals at carrying value minus depreciation. Yes. And then to get accumulated depreciation at the end, you say accumulated depreciation at the beginning plus depreciation for the year minus depreciation for for sold. Yes. So in this case, we didn't have sold vehicles, so we're going to say accumulated depreciation at the beginning of the year plus depreciations for the year. Ne? So our depreciations, accumulated depreciation at the beginning was 488,125 plus 77,969. So we got that that's 566,094. To double check if this is correct, you have to take the cost minus the accumulated depreciation. So our cost is 880,000 minus 566,000 566,094. There it is. See what we're getting? We're getting that 313,906. There's the 313,906. And then now we're going to, and then what is this? Equipment. It's right here. Equipment. So there's the equipment. We go and look for information about the equipment. So there it is. There's the information. What does it say? It says a loss of 2,000 was made on the disposal of all existing equipment, which took place on 28 February 2008. Equipment is depreciated at 15% per annum on cost method. Okay, a loss of 2,000 was made on the disposal, meaning that disposal means that the equipment was sold. They sold it, ne? And then they say of all the existing equipment which took place on 28 February, meaning that they sold all their equipment that they had, ne? Yes. So what did they have? They had equipment of the value of 40,000. We want to know what was the cost of that equipment. Let's do like this. Yes. So what we were given? We were given 40,000 plus a depreciation. We want to know how much was the cost of that equipment. In this case, we're going to say 40,000 plus 160,000. That will give us 160,000 plus 40,000. That will give us a 200,000. So the cost of these equipment that was sold was 200,000. Yeah. To prove this, if this is correct, you have to say 200,000. 200,000 minus 160,000. It will give you that 40,000. And then now we have to look for the disposals at carrying value. We want to know when they were selling that, when they sold that, what was the value of the equipment when they sold it? Yeah. Okay, so now we are required, we will have to calculate the disposals at carrying value when the value of the equipment that was sold, and they said that they sold all their equipment. So we want to know the value of the equipment when it was sold, and it says in the information that the equipment was sold on the 28th February 2008. So there it is. So this is the value of the equipment here at the beginning of the year. So now we want to know what will be the value of the equipment at the end of the year. Yes. So what we're going to do is that, let's move this, is this, we know the current value. We have to calculate the depreciation for the year, so that we can know at the end of the year how much was we'll know the value of the what of the equipment. So the value now is 40,000. So it said, oh sorry, I made a mistake. It says equipment is depreciated at 15% on what? On cost, not at carrying value. So the cost of this equipment was how much? Was 200,000. Oh, focus. Yeah. The cost of this equipment was how much? Was 200,000. So, yeah. It says equipment 15% at what? At cost. So the cost of this was 200,000. They said 15%. It stayed for how long? Because it was sold on this day, meaning it stayed for 12 months out of 12 months. So there you go, 12 out of 12. So you want to know what was the depreciation for the year for this equipment. Times 12 divided by 12. So the depreciation for the year for this equipment was 30,000. What was the value of the equipment? It was 40,000. Minus that 30,000, which is the depreciation for the year. On what? On the sold. It's the sold. So what you do, the value at the end of the year was 10,000. So that was what we were looking for here. 10,000 was the value, disposal at carrying value. The time they sold this, its value was 10,000. Yes, so we calculated this is the carrying value, this is the depreciation of sold during the year. So now we have to calculate for new depreciation. They said our cost. How much was the new equipment that was sold? It was 180,000. At how it costs, so it's gonna be times 15 times. So when was this new equipment bought? Oh, they already calculated the so in this case, guys, it seems like the thingy, the equipment 108 was bought on the same day they sold the equipment, so there won't be depreciation for the for the new equipment, ne? That one we won't have it. We'll only have depreciation for the sold one, because what happened is that on this date they sold their 200,000 with their equipment with the cost of 200,000, and then on the same date they bought that 1.8. Yes, this is what happened. So there won't be what depreciation on this, but there'll be depreciation for that. I hope it makes sense, ne? So now you have to what you have to get carrying value at the beginning of the year for equipment. So I said it's going to be carrying value at the beginning, which is 40,000, plus depreciation. Oh, sorry, plus additions at cost, which is 180,000, ne? Minus disposals at carrying value, which is 10,000, and then minus depreciation for the, which is 30,000. So carrying a value at the end will be that 180,000, and at cost the cost will be the same, because this is what we have that was sold, ne? Cost that was sold, so we left with what? This. So that is what we'll have. So guys, the accumulated depreciation at the end of the year, we will not have it at this point, ne? I said accumulated depreciation consists of accumulated depreciation at the beginning of the year plus depreciation for the year, ne? Minus depreciation for sold. So this equipment, this accumulated depreciation is for this equipment that was sold, and this depreciation was for the equipment that was sold for the year. This was the depreciation from 1st March that we opened with, and then we calculated this still for the what? For the sold equipment. So for this period of 1 year, this was it. So we will have 0 in the accumulated depreciation, because our method to calculate accumulated depreciation is accumulated depreciation at the beginning plus depreciation for the year minus depreciation for sold. So these were all sold, so their depreciation was 190. So that is it. Let me show you how it will be. You will just say, oh, my phone's so slow, guys, sorry. So you're going to say 160,000 plus 80,000 gives you 190. Accumulated depreciation at the beginning plus depreciation for the year as a whole, then minus depreciations for sold. They both sold, so you're going to say minus 190, meaning no depreciation. You'll calculate depreciation for the following year for this. So this business is left with equipment with the cost of 180,000. So next year they will be calculating the depreciation. So now if they asked you to complete the asset disposal and the general ledger, this is what you're going to do. I always like to I'll like to introduce you steps. There's these 5 steps, and I would advise that you follow them because they're gonna make things easier for you. If I had a color, I was going to put color so that, yeah, some people like it, like working with colors. So step 1, you look for the cost price of of the sold asset. In this case, it's equipment. Second step is you look for the total accumulated depreciation of of the sold asset, ne? Depreciation of the sold asset. Thirdly, you look for the carrying value of the asset. On the fourth step, the selling price of the asset. And then 5 determines if you have a loss or a profit on the asset that you sold. Okay, so in this case, we said that the cost price of the asset is how much? It is that 200,000. And then what you're looking for, total depreciation, which is the accumulated depreciation of the sold asset plus depreciation of the year, for the year, on the on the sold asset. So that gives us the total accumulated depreciation on of 190,000, yeah? And then the carrying value of the asset the day it was sold. So we said to get the carrying value, we're going to say 200,000 minus total accumulated depreciation. So the difference here, it is 10,000. So this is the carrying value of the sold asset. And then we look for the selling price. So the selling price was not said here, but we were given the that we made a loss of 2,000. So the selling price will be the balancing figure in our T account. So we already know that we made a loss on sold equipment of 2,000. Yeah. So in this side, we're going to say what did we sell? So we sold on the carrying value of this the cost price of the equipment. So we're going to say equipment. How much was it? It was 200,000, the cost price. And this side will have the accumulated depreciation. So we said the accumulated depreciation, you just take it from there, put it here. So it's gonna be 190,000. Sorry, it will go to the GJ, general channel, not yeah. And then you say, they said what else? And then we're still looking for the selling price, ne? We're still looking for the selling price. So they said that we have a loss of 2,000. The loss is on this side, and then the profit will be recorded on the other side. So we have a loss of 2,000. So the balancing figure will be the amount, the selling price in this case. So which one is the bigger side? This one is the biggest side, which is 200,000. 200,000. So the balancing figure in this side will be the selling price. Asset can be sold using, like, you can sell it on credit and you can sell it cash. So if they do not specify if they used credit, they sold it on credit or cash, just write cash. And when you write cash, if you sold it on cash, you say bank. So you received how much. So the balancing figure, when you say 200,000 minus 2,000 minus 190,000, you will get 8,000. So let's do it. 200,000 minus 190,000. Oh, sorry, minus 2,000. You're getting what? 8,000. So meaning that they sold this equipment for 8,000 rands, and then they made a loss of 2,000. Then they say, no, you have to record everything in the general journal. Ne? Then you go to your general journal, you will say depreciation. You know that depreciation is an expense account. So you take your depreciation for the year, which is that 30,000 rand. Expenses increase on the debit side. Please, and at this point you have to be sure, when you are a grade 12 learner, you have to be sure, you have to be able to classify your accounts. You must know your if the expense increases on what side and whatnot. Ne? So yeah, so we have depreciation with what? Accumulated depreciation, because you record it in your depreciation account, and then you go again and record it in the accumulated depreciation. Accumulated depreciation account, it's a non-asset account, so you will record it in the credit side, because the accumulated depreciation account increases on what? On the debit, on the credit side. Yes. So we have depreciation and accumulated depreciation, and then we have asset disposal. So your asset disposal, you will write the cost, that, see, that cost of the equipment, and then you'll have what were you selling the equipment. Yeah? Your equipment will decrease. So equipment is an asset account, so it increases on the debit side and decreases on the on the credit side. So in this case, you sold the equipment, so the equipment will decrease on the credit side with what? With that 200,000. Then we'll have what again? Asset disposals. Let me turn my book. Then again you'll have what? Asset disposal. Asset disposals. And then the loss will be on the what? On the debit side, which is 2,000. And then we'll have loss on sale of equipment. It will be on the what? On the credit side, because for every debit there's a credit. Just to give you an advice, if you really do not know, if you only know one between these two, let's say you know that you have to record the debit, the depreciation on the debit, just assume that the accumulated depreciation will be on the credit. You see, this asset disposal is in the debit, and then the equipment is on the what? Just to give you an advice if you're really struggling. So here we're having asset disposal. It's debit because it's no, I made a mistake. It's supposed to be on this side because it's a loss, and then this on this side. Yes, I made a mistake. Just because it's asset disposal, yeah? So it's on this side, on the credit side. It's just because it's a loss. If it was a profit, it was going to be on the debit side. I made a mistake there. And then loss on sale of asset, because it's a loss, it's going to be on this side. Yes. And then lastly, we have the what? The bank, because the money that you sold the asset, the equipment for, will go to the what? The bank. So the bank will what? Will increase. And then there it is. So we're done for today, guys. I hope that you enjoyed. If you want me to help you with the account classification, just say then I will help you with, I will upload a video explaining. I hope you enjoyed and you understood. If you have questions or requests, please comment down below. Thank you.